Welcome to our deep dive into dividend investing, a strategy for building sustainable wealth. Let's get started. Dividends are payments made by a corporation to its shareholders, usually derived from the company's profits. While not all companies pay dividends, those that do are often seen as financially stable and confident in their future earnings. Dividend investing involves buying stocks of such companies to receive regular income. It's crucial to understand the types of dividends, payout ratios, and yield to make informed decisions. Today, we'll explore how to select the best dividend-paying stocks for your portfolio. Dividend investing is a favored strategy for many, especially those seeking steady income streams alongside capital appreciation. While exact percentages vary, it's estimated that a significant portion of individual investors incorporate dividend-paying stocks into their portfolios. This method is particularly appealing to retirees and those planning for retirement, as it provides regular income. Institutional investors, such as mutual funds and pension funds, also heavily rely on dividends. The stability and predictability of dividend payments make them an attractive option for investors looking to reduce volatility in their investment returns. When selecting dividend stocks, consider the dividend yield, growth, and safety. A high yield might be attractive, but it's essential to assess the company's ability to maintain and grow its dividend. Look for companies with a consistent track record of dividend payments and growth. Also, evaluate the payout ratio, which indicates the percentage of earnings paid out as dividends. A sustainable payout ratio suggests a healthy balance between paying dividends and reinvesting in the company. Diversification is key in dividend investing. Don't just focus on high yields, consider different sectors to mitigate risks. Utilizing dividend reinvestment plans, DRIPs, can compound your returns by automatically reinvesting dividends into additional shares. This strategy leverages the power of compounding, allowing your investment to grow exponentially over time. We'll also touch on the importance of monitoring your investments and knowing when to reallocate your portfolio. Understanding the tax implications of dividend investing is crucial. Dividends are taxable income, but qualified dividends are taxed at a lower rate than ordinary income. Planning your investments with tax efficiency in mind can significantly impact your returns. Finally, patience is vital in dividend investing. It's a long-term strategy that rewards investors who are willing to wait for their investments to mature. Remember, the goal is to build a sustainable income stream and achieve financial independence. That wraps up our guide to dividend investing. With the right strategy, patience, and research, you can build a robust income-generating portfolio. Happy investing!